Okay, we are back for part 2 of CVP analysis. So I want to talk about the other type of formula that we run into, and that is, what is break even in dollar amount. Now we did the break even in units, so what's the break even in dollar amount? And what they have here is this formula: fixed cost divided by contribution margin ratio. Uh-oh, that's a new one, huh? The contribution margin ratio. Let's think about that for a second. Whenever I was teaching accounting class, financial accounting, we'd have an income statement, you'd have to do a vertical analysis, and so I'd say everything's going to be divided by sales when you're doing vertical analysis. So sales divided by sales is going to be 100%. Okay, and then cost of goods sold divided by sales is, let's just throw something out there, 60%. And then that means that gross profit divided by sales is going to be 40%. And then you go through all the operating expenses, boom, 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 boom. Everything's divided by sales, everything's divided by sales, everything's divided by sales, everything's divided by sales. And guess what? It's the same thing in CVP analysis. Everything is divided by sales. So if you're looking for the contribution margin ratio, you take the contribution margin and divide by sales. Oh my God, I just died and gone to heaven. Here it is. Contribution margin, 200, divided by sales, 500. Well, what's 200 divided by 500? Ooh, let's think about that. 40%. Yes, it is 40%. Okay, so if I got 40% for my contribution margin ratio, then that means that my ratio for sales is 100%, just like I was doing down here. Sales is going to be 100%. So sales is 100% ratio, because everything's divided by sales. Then my variable cost, 300 divided by 500, is going to be 60%. And check it out, folks. 40%, 60% equals 100%. These two, variable cost and contribution margin, the percentages are equal to 100%. So if you're calculating this thing and you're coming up with some numbers that do not add to 100%, you better go back and look at it again because you did something wrong, okay? All right, now let's go back to this. Fixed cost divided by contribution margin ratio. I don't need to tell you this again, but it's not about fixed cost. Swear to God, it's not about fixed cost. It's not. Okay, it's about the contribution margin ratio. And it says that if you take the contribution margin and divide by the ratio, by contribution margin. If you take contribution margin divided by the ratio, which is the same thing as fixed cost, then you get the dollar amount. Let me go through that again. According to the formula here, if I take fixed cost divided by the contribution margin ratio, if I do 200,000 divided by 40%, I get 500,000. But if I do the same thing with contribution margin, which is the same dollar amount, and divide contribution margin total by the contribution margin ratio, I get 500,000. Okay, now you probably don't believe me, all right? So I'm going to prove it to you mathematically. Let's go through this. I'm going to just look at this one over here. If I take 500 and I multiply that by 40%, I get what? 200. Okay? That is my contribution margin per unit. Okay? At 40% contribution margin ratio. So if my contribution margin is 40% of sales, okay, then that's the same thing as saying sales times 40% is equal to my contribution margin. Now, just like it did over here where I went the opposite direction, I can do the same thing here too. I can take 200 and I can divide by 40%. Okay, I just went the opposite direction. I just went up the line and I'm doing it this way. If I divide by 40%, then I get 500. Here's a basic rule of thumb, folks. Every time you take a dollar amount and you divide by a percentage, you get a bigger number. Every time you take a number and divide by a percent, you get a bigger number. Okay? I just proved it to you mathematically because I took the big number times percent and I got a smaller number. Okay? When you do multiplication, it comes out this way. When you do division, it comes out this way. So by the same logic, if I take 200,000, divide that by 40%, I get 500,000. So here I am over at this example. If I take 210,000 contribution margin and I divide by 40%, I should get the sales dollars right here for 1,050 units. So let's see here. I got 210. Oopsie, I got a decimal in there. 210,000. I'm going to divide that by 0.4. And that gives me 525,000. So 525,000. Alrighty. And I can also prove this too. If I take 1,050 units, okay, 1,050 units, and I multiply that by $500 per unit times 500, I get 525,000. It's the same number. So I was able to prove to you that I got everything correct. Now, my variable cost, I could literally take the 525,000, multiply that by 60%, and I'll get my variable cost. Or I could just simply say I need to figure out contribution margin as being 210. My sales is 525. What does variable cost have to be to subtract from 525 to get to 210,000? Okay, it's simple math. It's going to be 315,000. I'm just subtracting 210 from 525 and I get 315. Or you could take the 525 times 60%, which is the ratio for variable cost, and you'll get 315. Okay, so let's prove that. 525 times 0.6, and I get 315. Oh, I just died and got into heaven again. Isn't it great? I love it. This is what I like about CVP analysis, because it's very mathematical in orientation, and it's very, very logical. I think probably somebody who is really good at math figured this stuff out and said, hey, look, this is how we can figure out our profit and loss for our company and make sure that we make enough sales to at least break even or to make a target profit. That if we want to have a target profit, we have to sell this many units. And they mathematically figured it out by using contribution margin. And it's going to be the same if you have a target profit. Instead of doing fixed cost plus target income divided by the contribution margin ratio, all it is this is what they're talking about, the fixed cost and target income. You add these two together and that gets you back to contribution margin. So again, folks, we're talking about contribution margin, not this stuff that's in here. They had to quantify somehow, okay? So again, I'm not knocking the brilliant, intelligent people who put this stuff together. I'm just saying, don't let this thing wind up bogging you down thinking you have to memorize another formula. Just look at the logic of how it works, okay? And by the end of the semester, you will have grown Vulcan ears and we'll all look the same. You guys have a good one. Take care now.